Good afternoon, everybody. Welcome back to Bull Sessions. This is our August 19th, 2025 edition or session. My name is Mark Robertson, and I'm joined here by my dear colleague, Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark.
And,
We're getting ready to do lots of stuff here, so I'm kind of excited about everything right now.
yeah, we had a good session last week. A number of you wrote to us and had some comments or suggestions. We greatly appreciate that. So good, clean fun. We're also joined here by Matt Spielman coming to us out of Houston. I think you're home now, Matt. Is that correct?
Yeah, we are. Soggy, but slightly cooler Houston. Some storms came through this morning at school bus time.
Ah, well, I talked to Ann Manning yesterday, and she said you had 99 degrees at one point yesterday.
Yeah, it is not the season to be an ice cream lover. You have to bring your cooler with ice into the store if it has any hope of survival, or to shop at 10 p.m.
Well, Matt, you'll be happy to hear that we're in the middle of August and in the 60s here right now, and they're calling for a frigid winter with lots of snow in the Farmer's Almanac for Michigan. So we'll have to see how accurate they are.
So now we got to get out the forecasting stuff again and analyze the Farmer's Almanac too. Matt is
that's why we
all
don't
kinds of
ask you guys
forecasts
down here in August.
Good stuff. All right, we're going to talk about Palantir and early stage analysis a little bit. I did demote foundational selling and promoted it to next week's session and perhaps a week after that, but we have a pretty full slate here today, so let's go ahead and get underway. All right, here's your standard disclaimer. Boilerplate, no investment recommendation whatsoever is intended by what we do here. This is all demonstration and education. Do your own homework about anything related to investing, period. If you want copies of the slides or you have questions or suggestions for future topics, our 2 email addresses are on the page. And I am always grateful to open up a few of those every morning now. And you guys send me tips and news about Portillo's and all that kind of stuff. Thank you.
The disclaimer took 18 seconds today, Mark. That's a new record.
A new record. Okay, and here's another record. Portillo's continues to struggle. I have not sent my money to them yet, although I have been deliberating over it. And current ad that they're running, that would fix me also. And I don't remember exactly who sent this, but I actually got it from 2 people. Oh, and by the way, Matt, I got several emails from Texas publications talking about and asking the question, is Portillo's expanding too fast? So if you're one of those people out there and you're listening right now, go to your room. But I've got a bunch of those. I couldn't bring myself to share those with the audience, but there are apparently a lot of Texans out there are concerned about the growth rate. They are opening stores in El Paso, Lubbock, and a couple other places. So there is.
Yeah, the good news is they were a big hit in Dallas, which is not an easy market, and I think that they went full speed ahead and got a little ahead of themselves, but the potential's there.
Well, that's good. I think I'm going to hold and hope that I don't have more tax losses to offset gains eventually. But those are the insiders that recently bought, and you can see there's some pretty good sized chunks there, but it's all relative to what they hold in their total portfolios. And again, I don't get too hopped up over insider buys or sells. That's a topic we could talk about sometime, but I think there's very little correlation between insider buying and selling and what you actually see happen. That's my nutshell analysis anyhow. All right, let's keep rolling. Number of things going on this week. We are going to jump in the time machine, do a little time travel. Ken and I here in a few minutes. We're heading to Atlanta for an investors fair this weekend, their 11th annual. I think the thermometer picture there goes very well with Atlanta this time of year. And this issue does include all of that landman type stuff with Chevron and Exxon and all the oil and gas related companies. So that's what's going on right now. All right, what do we see here, Ken? I noticed that last bar is caught up to the trend.
Yep, it's up to trend, up to the average market. So that means that it'll be it won't be easy to find stocks that might be affordable, but it's not any harder than it normally is. And we're getting some separation again between Value Line and MyPar, and that kind of breathing in and out, you know, close, not so close, close, not so close, seems to be pretty normal if you look back on this graph for the last 8 or 9 years or so. So I don't think that we're seeing anything new or different on the graph right now. I'm happy to see the bar up to the line of expected growth again. And I would hope that it would stay up there, maybe just touch a little bit higher than that even would be nice.
And then Matt had pointed out yesterday that it was near the end of the day and we were running at about 25% of normal volume. Did that come in any higher than that by the end of the day, Matt, or is everybody on vacation?
No, I didn't check it at the very end, but I don't think there was any kind of spike to take that over. I think there was a lot of waiting and bated breath. My metaphor was that Jay Powell's going to take a putt on the 18th on Friday, and the gallery's quiet right now.
And yeah, he's either going to put us in the hole or slam it off the stick or something. Who knows?
The common knowledge is when volume goes down, volatility goes up. Is that correct?
It could. So we could see some, but you know, I think a bunch of them are out at the Hamptons, soaking up sunshine and umbrella drinks. But and Ken, from time to time, you've talked about the difficulty in understanding and analyzing Salesforce.com, and I have to plead guilty. I don't understand how good RX works. Maybe we need to do a deeper dive on it and take a closer look. But they had a fairly major announcement that they were coming out with one of the GLP-1 drugs, and Novo went up on the news also. So we'll talk about Novo. We don't want to talk about United Health today, but we'll talk about Novo if that's going up. So we might take a look at that in the greater detail. So let's go ahead and punch forward. Here's an update of the top 20 funds, that's mutual funds and exchange traded funds. You can identify the traditional mutual funds by the ticker. They're preceded by the M, that stands for mutual fund, and they always have 5 letters. The rest of them on there will be exchange traded funds, which again trade more like stocks. And Ken's baby there up at the top, Nukes, it's a brand new ETF, but it includes Oklo and SMR and a few other companies. And it's just off the charts, red hot. Len Douglas actually shared that you can't buy it through Merrill Lynch. Did you know that, Ken?
I did not know that, no, and I have yet to purchase this. I've gone into some of the individual stocks within this particular thing. I did include this in my groundhog competition portfolio, and we have it on our list of best small companies as well. We very rarely put an exchange traded fund on our list, but this one we did put on our list.
Best small companies, yeah.
Yeah, I also asked Mark before we started whether there were 21, 22, 23 on the list that were still at 5% relative return, and got the answer that no, there were exactly 20 out of the 650 or so that are returning 5 or better in relative return. So that's a pretty elite group of ETFs and mutual funds that we're looking at here.
Absolutely. A good place to go shopping amongst many of these. We've talked about Granny there at number 10. We really like following along with Tom Lee. We'll talk more about him as we go forward in coming weeks. But Ken, I was advised that if you happen to win the Groundhog Challenge, there may be it may be contested, you know, with this Nukes in there. You know, it's kind of an unusual selection for you.
Well, it was, but I did it, so we'll see what happens. Okay.
All right, let's keep pressing on here. You read a lot about this notion of buy the dip. That just means buy the par when it goes higher. It's the opposite of thinking about buying the dip. You want to buy the rhino horn or the peak when it comes to return forecasts. But the vernacular on the street is to buy the dip. And the chart that I included on the right there, we're still trying to figure it out, but it implies that there's a waning of interest of some kind at some time. Help me out, Ken. In small cap
Well,
companies.
I think it's a badly drawn chart is what it is. We can't figure out what that red line really means, because if you read down at the bottom, that's 26 that they're talking about. So this is a prognostication. It's a forecast, and I'm just not quite sure what they're forecasting based on what data that's being used. So
Yeah.
that red line is probably, maybe there's truth to it from the 25 mark halfway down if they're going to try to do monthly dots or something, but I just can't figure out what it is they're actually showing me on this graph. So
I'll have to look at it a little bit closer there. I think there's probably 8 months of actual and then an extrapolation or something there. But what it's basically saying is that there's hopefully temporary uh, reduction of interest in small companies, small caps. So, and
well,
I'm
and I think we have to remind ourselves that small cap is not necessarily small company either. So
gotcha.
that should be something we should say constantly, because there's a lot of companies that are pretty big that sometimes turn into small cap companies. So
All right, I'm going to dig on it on a little bit deeper, and if I can't figure it out, I'm sending it to Ben Carlson as a potential chart crime.
chart crime, okay.
Speaking of chart crimes, here you go, Ken. This is a little more direct than we've said various flavors of this, but
we had a discussion at our family dinner table just this last Sunday about something almost identical to this. They were worried about what might happen if thus and such went on and everything. And I said, if it actually goes on, you won't be there to worry about it anyway. So take it off your plate and worry about things you can control. So.
well, my answer to this is to head for Brutus, Michigan. The town is actually in the epicenter of the safest place in the United States, if that were to happen. So there you go. All right. All right. In honor of our participation in the Atlanta Investor Fair this coming weekend, it's a peach flavored performance perspective. And what we've done is sprinkle a whole bunch of examples of companies that have been mentioned by some of us over the years. You can see that the round table's right down the middle. We hope to see that actually drift back up. But you can basically pick anything out here. Amazon, we're going to talk about today with looking back on that a little over 10 years ago. Apple, many of the people that are here today added to Apple between 2005 and 2015. I just love Susie's selection of installed business products. I can
I don't
remember.
understand how it got to the top of the list when it's smaller than the one beneath it. So,
Well, that's called fluctuation in pricing between the time I captured the chart and didn't resort it. I mean, we're talking a matter of a few minutes. Change that.
well,
So,
there we go. All right.
and that's NVIDIA's fault, Ken, not mine. Yeah, just some very interesting memories and moments. I think we should probably do a version of this for the National Convention, Ken. We can have a lot of fun with this. And all the way down to my personal confession story about Body Central that sends chills through all of the Knights of the Round Table and the damsels anytime I talk about it. We only held it for 2 months and lost 43% in 2 months as the company went bankrupt. And it was a company with no debt, and they went bankrupt. So there's a lesson there somewhere. But a lot of fun, and we'll have some fun in Atlanta this coming weekend. I thought this was a nice way to celebrate the Atlanta event. Many of you know Cy Lynch personally, and that was a fun moment there on the left that we celebrated a few years ago. But I just love the thinking on the right, Ken. Does that make you happier with that one share mentioned?
Oh, I think that all the boxes kind of blend with each other. This is just a great example of better investing philosophy, manifest investing philosophy, everything else. Find a high quality company, and if you can, stick with it for as long as you can.
I happen to know that Cy holds the shares that he bought back in the 1990s. So, I mean, if you paid 11, he says he paid approximately 12 for most of his shares.
Yeah.
And is collecting $9 a year per share in dividends. I mean, just think about that. And this is the type of thing that if you can get somebody to, set aside $100 or $500 or $1,000 or whatever the federal program for the newborns ends up being, this can happen for people. And better investing can help you figure it out.
Our audience is always trying to keep us on our toes, Mark, and Dwight out in our audience today is suggesting that IBP is installed building products,
Oh,
not
did
installed business products.
I?
So
Oh,
before you put this out in Atlanta, you want to change that name if you can.
all right. I'm gonna. Everybody out there, work with me here and imagine the word draft on this slide, and it's unsorted, and I will fix that. And Dwight's absolutely right. Installed building products. The story there, by the way, is you don't have to find the next Microsoft. You just have to find the next installed building products company. All right. Well, here's Ken's opportunity to revel. I will just point out that the numbers are more green on the left-hand side of the page. And I am not close to last place. I'm actually pretty close to the Wilshire 5000 right now. So I'm a little happier. I'm not happy enough yet.
You're making your surge, right?
That's right.
Okay. I told Sharon before we started that she should look at the list very carefully, and Mark's included the top 50, and Sharon Saras from Northwest Buckeye chapter has just snuck into the 50th spot right there. So we're happy to welcome her to the top 50. Ethan, if you're in the audience, your name's not on the list anymore. And Don, if you're in the audience, your name's not on the list anymore for the moment. So I get a couple of weeks to revel in that fact and get ready for the Wolves meeting. And then probably it'll all turn around again and I'll have to pay obedience or pay something to you guys to mention your names again. So.
Yeah, a lot of very familiar names up at the top. Power City Ladies, 3-time champions, along with a couple other repeat champions in the group category in the top 12. But right there with you at number 13, Betsy. Betsy's going to join us in a couple of weeks as we kick off the small company quest. And just a lot of very familiar names on this list, from including Robin and Marie and Sandy and the whole
Well,
bunch.
this old geezer is proud to be one spot ahead of the young pup there of Mr. Mace. So he doesn't take any. He's never reluctant to poke fun at the fact that I'm older than he is.
Yeah,
So
yeah.
you know,
I wonder if he's got GameStop in that portfolio. I'm gonna have to check.
he might.
Yeah, good stuff. All right, let's keep rolling. Here is the current look at the Buttonwood portfolio. It has stabilized and improved a little bit, even without United Healthcare in it. And this slide here made Ken smile a little bit earlier today because there's a little bit of a wrinkle in the current balance. That blue line on the right-hand side. We've actually had a pretty good last few days. So we look forward to watching this slide over time and see what we can learn from it.
Well, and it's also pointing out one of the most counterintuitive things for clubs to understand, and this is pointing it out in a really nice way. And we know all the time that when price goes up, portfolio par tends to even out or even move down a little bit.
Mm-hmm.
And that's what the graph is showing us right here. That's something that people have to really stop and think about why that's happening. And then they understand that, well, hold it, this is potential out in the future. And if you draw some of that into right now, then there's not as much of it for the future to hold. So it's a good graph. This is a graph we should have been doing a long time ago. I also want to look back, you can go back to the portfolio itself, Mark.
Sure.
And I just want to keep us focused on that sales column. And that sales column had been a little bit more robust than it is right now. And there's a couple of candidates in there that with very, not very low, but with lower sales that we might want to in a couple of months or see how it works. But as long as Lulu is doing a 15% par, I don't want to move it out of the portfolio. But at a 6% sale, it can't continue that par at 15 for a long, long time unless it starts to push
Yeah.
that up a little bit.
And
So
I would just say, we have to also be patient. Sometimes that's just the analysts getting overly pessimistic, driving that number down.
absolutely.
So we want to be watching that also, and just be aware that that's the case. The one that
And the only,
frustrates me is Schlumberger, Ken. I mean, Schlumberger
well, I
always.
can't figure, Schlumberger might be a great example of a rule of five stock, Mark, that well, we continue to look at Schlumberger, and I've looked at Schlumberger a half dozen times over my investing career, and I've had this experience with it a number of times that it just doesn't seem to behave the way I expect it to behave. The other one, Mark, that we've put a little bit of a note next to is Gentex with that 7.6% sales, and I think we both are beginning to notice that as Gentex does better, the par goes down. And as the par goes down, Gentex becomes more and more of a stock that we might want to take a look at taking some of the profit from, if there is any profit, and moving it into something else. It's
Mhm.
not there yet, but it's certainly one that we've been looking at now for the last 3 or 4 or 5 months. So
Okay. Go ahead, Ken. Here's some more portfolio
well,
record keeper
I
stuff.
I got a lot of mail on this program that Matt Wilms puts out with Quant9 software, QUANT, and then IX for the 9, the Roman numeral 9. And he puts it out, and people said, well, what can the program do if you put in all of your data? And so I'm just showing you some examples. This report takes about 6 seconds to generate. And if you're ever looking for an internal rate of return for your entire portfolio from the start of when you put data in Buttonwood's case, this is all of the data included since we began the portfolio back in January 2024. And it gives me an IRR, an internal rate of return number for the entire portfolio for the entire specified period. And an internal rate of return of 2% isn't where I'd like it to be, but Mark has double checked this with his calculations, and we're finding that the calculations match as we think they should. They do. You annualize that 2% return over the about 20 months we've had the portfolio moving, and it
Mhm.
annualizes to about 1.4%. So it's positive, and that's the most positive thing I can say about it right now. The next slide shows a report that I can generate for my portfolio now in about a second and a half. And what I like when I do this for my personal portfolios is I can get a handle on capital gains without having to do a lot of extra work. And it just keeps a nice tally going for me. It gives me a rough idea in the middle of the year whether I really want to harvest a lot more capital gains or not. Where am I in my different portfolios that I manage? And then, of course, there's many, many other types of things that are happening down there. A lot of that stuff you don't do in a normal personal portfolio, but it's all there just in case you do choose to do that. It's a really nice allocation. Just remember that that allocation is a capitalization allocation. It's not the kind of allocation we look for diversity in manifest investing or better investing, but it does say that most of our companies that we're looking at would be classified by the market as large cap companies.
I'm surprised that it's as skewed as that suggests. So Might have to do some
Yeah.
digging on that and think about it. And here's your.
And then just one more concept. This report goes on for 3.5 pages of paper if you want to print it out. But what it does is it gives you a great breakdown of all the lots that you have in the different stocks, and it shows what happens when you're buying stocks with huge fractional pieces to them, or at least when you're buying those types of lots at Robinhood Brokers, and that's our brokerage firm, Robinhood. And you'll notice that when we make a purchase of some of our stocks, look at XL Holdings, the second one on the list, for example, and we wanted to buy about 6 shares, but we didn't want to buy it. We thought we were buying just one lot of 6, but actually Robinhood bought 3 different lots, 1 lot of 5, and then 2 lots of fractional shares. It'll buy as much as 1/1000th of a share. You can see in Gentex there, because we asked for a dollar amount to be bought at that particular time, and that dollar amount rounds off to 0, but it had enough fractional pennies on it that it made the dollar amount match exactly with the dollar amount we wanted to purchase. So it's a great report, especially when you're trying to sell, because the report will do first in, first out for you, and it makes it quite easy when you have lots of the same stock. But these are just a sample of the kinds of reports it writes, and I'm not going to do this every roundtable, but if you have questions, I would urge you to go. The brand new version is out there right now, and Matt is giving you a trial period to play around with it a little bit. I would urge you to go and just put in a small trial portfolio and see how easy it is to create, and then how easy it is to write reports on it.
Excellent. Thanks, Ken. Yeah, I'm going to definitely dig in a little bit deeper on that. I've used the program periodically over the years. I'm just not disciplined enough to continue doing it forever like you guys. But
neither am I, but my wife is. So
I know it. I
that's
have one.
great.
I have one of those too that she wants to understand more about. She seems to like that dollar end of it all. There's something about the percents and all these ratings and all that stuff. That stuff is all fine and good. What can I buy with that? Is kind of the question. All right, Rule Breaker. David Gardner's book is coming out in the middle of September. I really believe we will probably do a full review of this book along with taking a look at Rule Breakers in mid-October as part of our small company quest for this year for next year's best small companies. So you're forewarned. The book is out there. Here's just a reminder that we did publish a list of or a summary from Notebook LM of what David believes to be the characteristics of rule breakers. I'm going to move forward because I'm going to show you where we've talked about that in the past. Here's some current examples offered up by the book, and we invited you to go ahead and nominate others that we can consider and see how they fit the matrix. And that's right here. These are the ones that you guys have submitted so far, in addition to a couple that we've placed on the list, and we're going to subject these to the analysis and decide which ones we think truly are rule breakers. And as Ken refers to them, dashboard destroyers.
And they are, believe me. I'm fascinated by the fact that there's some very well-established companies on this list that have come from our audience, and I'm not quite sure that everything on this list is a rule breaker kind of company. And I'm looking forward to talking about why we might think some of them are really rule followers rather than rule breakers. So,
yeah,
great fodder for future discussion.
Candace Baker says this one has to stay no matter what we decide, Ken. So comfort systems. That is a roundtable selection by St. Louis's own Candace Baker. All right, so let's go ahead and talk about Palantir. We have about a half hour.
Mark, we have a request to go back to the rule breaker criteria quickly, just to
Okay,
review that.
okay.
I don't know if there's a further question.
Go ahead, Matt.
Just waiting.
There doesn't seem to be a question. The person, we don't even know who it is, just asked us to go back and put that up just for a couple of moments again.
Yeah.
Again, folks, if you need to review the slides, drop Mark an email at mark@manifestinvesting.com, and we'll send you the slides, and you can review them forever then. The person says, got it, thanks. So let's continue, okay?
Yeah, we will, and I'm actually going to display a slide and show you where to find where we discussed these one by one during a former bull session. And Ken, you'll remember it when we get there.
Well, I remember it without getting there, but that's okay.
All right, so let's go ahead and talk about Palantir. It's a company that we have talked about quite a bit in our circles, and we're not the only ones thinking about scratching our heads over the soaring valuation. I have gone so far as to say, is this company Palantir this year's NVDA when it comes to how rapidly it's gone up and how difficult and how challenging it is for the analysts trying to follow the company. So you see headlines there talking about market euphoria, and there's just a whole bunch of stuff going on. Notice the distribution of recommendations from the parade of rhinos. And it's not often you find as many sells as buys when it comes to any company out there. This is really quite a distribution. I mean, the majority of analyst recommendations out there they live in the buy, outperform, and hold categories, with rarely dipping into underperform or sell. And maybe that's just because they're just generally optimistic people. But there's a strong bias to the top side of that. You can see here that there's just a whole lot of people. Ken, I'm going to go ahead and confess that you and I both hold shares of this company in our family portfolios, and
I hold it in a tax deferred account in an IRA, right?
right. So we both are, scratching our heads. It's gone up massively. It was not in any shape of or form of a buy zone at the time we bought. I bought somewhere around 70. I don't know how long ago, but it's approaching 200 now.
Well, this is the
less than a
part of
year.
my IRA, Mark, that Mr. Nicholson suggested was called non-traditional stocks. So I have Palantir in my portfolio, and I'll admit it, it's a non-traditional stocks, and it sits right next to Oklo and to New Scale Energy. So there they are, three of them.
Well, you're on a hot streak there for somebody that's been avoiding those type of companies for the last couple of years. So we'll
Well,
try.
and my wife has Credo, so we got four non-traditional holdings in the entirety of our portfolios. We only have those four, so I don't want to give people the impression we just run out and buy LAZR or what's that drug stock? ARDX. We just don't run out and buy those things willy-nilly.
I think Ardelyx has a PE now. They might. I'm not even sure, but the question that we asked here last week was, did your club partners throw you out of the room when you suggested that you bought Palantir at a PE that has 3 figures in it, 3 significant digits anyhow, and it's just quite a quandary. And then we actually posed the question, could it still be undervalued, or at least not as overvalued as you think it is? And that's just
I was waiting to see the great defender of Palantir make an appearance in my questioning box here, and Marie, who has done well, she has. So she's done all kinds of posting on the Manifest Investing forums, defending Palantir, explaining Palantir, and I've read each of the postings with a lot of interest, and I followed her lead in putting a little bit of money into it.
Mm-hmm.
But she's making the point, Mark, that there's a lot of institutional bias against Palantir.
Absolutely.
Due to the fact that they went public in a way that is not very traditional. They did not use a traditional IPO to go public. They did a DPO, and I think that stands for direct public offering, if I'm not correct, if I'm not mistaken.
That's correct, and then I'll actually underscore what she had to say. And many of you here today will remember BioReference Labs many years ago that they did the same thing, and they really, I would use stronger language, but this is PG. They really ticked off a whole bunch of the rhinos, and
We
I don't know if they were ever forgiven.
We have a hand in the air from the president of the Houston Better Investing chapter, Mrs. Ann Manning. So, Ann, you're unmuted. Go ahead and chastise somebody.
Well, no, I just want everybody to thank me for Palantir's rise, because I bought 400 shares in 21.
Oh,
It didn't do anything. It went down, 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 and it went back up a little bit. So I sold it in February of last year.
uh-oh.
So
It's the kind of
I just
timing
want
that
y'all
Mark
to
has,
thank
Ann.
me
You
for
know?
the rise.
Well, thanks, Anna. I mean, my brokerage account appreciates you. All right, so let's go ahead and talk about this a little bit. We talked about last week, and what it really comes down to, and we're going to delve into this pretty deep. Where do you think the profitability of this company is going? You know, it's a relatively new company, and we're going to take a look at it kind of step by step here. And here is the same type of thing we talked about last week. We just want to expand it to talk about this notion of projected return on value that we use. We think that it can be applicable to early stage companies, especially companies that have weird or don't even have a PE ratio, because we don't use that in the proof calculation. So you'll see how we do that. So it does enable us to look at companies that are earlier in their life cycle, early stage companies. And we'll go through and talk about all of this, but I wanted to pay tribute to Brian Feraldi and Kathy Wood. Brian and Kathy both cover the subject of life cycle awareness and S curves. You can find a lot of stuff on Kathy with S curves. And we just encourage you to dig in a little bit deeper. We've talked about them all a lot here at Manifest. We're going to look at that also. But the red box warning applies here. And if any of you out there think that Ken has 40% of his total assets in Palantir, you're wrong.
You're very wrong. Yeah. Mark, I wanted to make the point that if you're going to invest in something like Palantir, that you really have to put in the time to understand what it is exactly that the company does. And I don't mean you have to go through the balance sheet with a fine-tooth comb and understand every single financial term that exists in their annual report. What I mean is you need to try to understand what they're doing to make money. And especially when you're trying to determine things like profit margin, the more that a company, in my experience at least, the more that a company veers towards services, the higher the potential profit margin is for the company, because they're investing in ideas and people rather than in factories and capital goods. So I want to understand if it's possible, and some of these tech companies, it's very difficult to get your arms around the business model, but I want to understand what is the product that Palantir offers to its customers. What is it actually trying to do? And I want to be able to state that in relatively simple English, so that if I'm going to buy it in my family accounts, my wife and I can both understand it. And if I'm going to buy it in a club account, so that all the members of the club can understand what it is that this company does in its most basic language. And again, I'm going way, way back to some of the gurus that we have great faith in, when they told us to try to explain things to your fellow investors in language that a third grader could understand. So that, I think that's so important. And so when we're talking about Palantir, I would hope that in the next couple of bull sessions, we can come up with a couple of paragraphs about what it is exactly that they do, you know, besides all the numbers that we're going to be talking about with the stock.
Exactly. it helps to understand the numbers, but you got to understand the story too. Ken keeps admonishing us for Ardelyx, and the story with Ardelyx is pretty simple too. It makes life better for kidney and dialysis patients. I understand that. I have a family member who's doing that. So, anybody that brings a solution to the table that makes Mike's life better, I can sink my teeth into that story, and that's the Ardelyx story. So that's why we're there. All right, so I actually
Well,
went back.
I will say, Mark, that the capital gains that I have from Ardelyx balanced out the capital gains that I have from LAZR, from Luminar. So I have a wash pretty
Yeah,
much on those two stocks. So
yeah. For all of his taunting, Ken bought it at 2 and sold it at 6. So Ardelyx we're talking about there. All right, so again, this projected return on value, we have made a couple of adjustments over the time, but what we're going to talk about here now is the fact that without a PE, a stock selection guide, a traditional stock selection guide is difficult, if not impossible. And what this approach does is allows you to take a look and perhaps back into a traditional analysis, and that's what we're going to demonstrate here. So it enables analysis earlier in a company life cycle, like Kathy and Brian would have talked about. So a few years ago, I just went back and grabbed this from, let's see, what was that? August 18th, 2020. So we're basically talking about 5 years ago. We were talking about the company Tesla in a very similar way. Very young company with exploding sales, increasing prices. You can see these are earnings down here at the bottom, I believe, that are basically below zero until it gets into that 17 or 18 time frame. So again, we're talking about a company that had a fair amount of sales, no earnings or profits until the right-hand side of this chart. Okay, and we put
it's important, Mark, on those graphs to remind people that there's projections on these graphs here. This is in 2020, so all those 2021 and 2022 data points are projected data points. That's important for if you're going to read this to understand that.
We take a look at what is going on. So here's just taking a look at a series of fundamental data for the company going back in that time frame. You can see the stock price was kind of all over the place. Projected annual return was, largely negative that you see here on the right-hand side, single digits. In most cases, people would come up with one of these, a question mark, back in that time frame. Earnings were lower, but if you actually used the projected return on value that you see here, you actually have something that you can kind of sink your teeth into and look for. In this series, the higher numbers are obviously right here in the middle, right around this. That is when I actually bought some, following the McManus principle we're going to talk about here, when the company was really beat up at one point in time. And you can see even Value Line had a positive low total return forecast in that time frame. So again, it kind of answers the question, has Tesla ever been theoretically attractive back in that 18 to 20 time frame? And there was a brief period in there where it actually hit some pretty decent numbers. So one of the things that this is probably one of the biggest things I discovered just this morning. I went to Chat GPT and I said, you know what? I can either sit here and go through PowerPoints until my eyes glaze over, going back 5 years, that's quite a few PowerPoints, right? Or YouTube sessions. I instead went and asked this question of Chat GPT. That's all I asked it, what you see right there. And it came back with March 26th, 2024. If you want me to, I'll take you actually straight to the YouTube video. That was the answer that came back from Chat GPT. Keep in mind that our YouTube sharing is completely public. And I just love that it pulled this David Gardner moment out because it applies to our experience with the roundtable and Microsoft. And we talked about that back then. And then for the rest of this session, we talked about rule breakers. And you can see those are the 6 things that were on that slide just a few slides back. And we went through them one by one and tried to interpret what David has said in his podcasts and previous publications. and we just kind of tried to put it in terminology and understanding that fits our world. So, all right, am I getting a standing ovation here? This is kind of cool, right? Am I wrong,
Well,
Ken?
it's just showing that how everything old is new again, and where we've kind of tried to say that we really understand and kind of agree with David Gardner when he talks about rule breakers.
Mm-hmm.
Only we have different vocabulary for it, and we like to maybe say non-core. But there's so many similarities between our non-core characteristics and his rule breaker characteristics that we can actually list them for you, and here they are.
Yep. Well, that's not what I was looking for, not the theme that I was looking for, Ken. So let's try it on this way. This is not what I was actually looking for. It's kind of cool that I found it, but well, I stuck this in here because this was actually part of that presentation back in 2020, and this is a good thing to know because next time you go to the zoo, it might actually save you.
Okay, next slide.
And of course, that merits that slide. By the way, I used to use that slide for the Detroit Lions. I don't have to do that anymore. All right. Okay, this is the really cool thing. I said, okay, the David Gardner stuff is cool, but what I really wanted was the Amazon and the Hugh McManus stuff. So I asked the question again. And ChatGPT came back with this. I was looking for that stuff back from 2020, and it went and found them. It took 2 minutes and 21 seconds to do this. I'm just kind of letting that sink in. You got to admit this is kind of cool, Ken.
It's more than kind of cool. I'm just thinking of the hours and hours and hours that I spent in research in libraries during my college career and my graduate career, and I'm thinking how this can short circuit so much research for serious scholars, you know.
Yeah, so you can use that same approach to find anytime we talked about any company during bull sessions if that's something that you wanted or needed to do. But obviously my attention is drawn here to this financial statement forensics with Hugh, and this is what I was looking for. So I could actually go back either on YouTube or in the Manifest Investing forum and access this stuff. So here it is. Well, this is a slide straight from that presentation, company life cycle and the stuff we were talking about with S-curves and Kathy Wood. And when we talk about launchpad companies, we're talking about that point in time during a company's life cycle where it begins to generate positive earnings and be welcome in the Ken Kavula watch lists and just the general way that we think about companies. Now, Ken, did you want to add commentary to this or?
Well, just that this is a very generalized picture, and not all companies are going to exhibit that decline. We have many examples of companies that reach maturity, and then that line, just the slope of that line either goes down very quietly, or it stays level, or it even just goes from a very explosive kind of growth to a much more stable kind of growth. And then if the company keeps reinventing itself, that more stable kind of growth can go on for many, many, many years. That plus the fact that this graph kind of suggests that these periods are equally spaced on the time continuum, and they're not really. The growth phase could be much, much wider than it is on this picture. The maturity phase could be much more narrow. There's no accounting for how wide the time will be for each of these different parts of the life cycle. But as a general rule, this is a great first attempt at showing what a typical company does.
Yeah, and the message that Hugh was sharing and we shared back at that time frame was cash flow generally breaks through zero before, and I say almost always, earnings. So if you're watching the companies in their cash flow, you can catch some of these in their pre-launch mode, and they're not all going to work out. I mean, Luminar is struggling to find that proper trajectory. We continue to hope for it, but again, cash flow is going to hit positive numbers before earnings, and it's one of the reasons the Value Line does what they do with cash flow, price to cash flow.
Yeah, I think the only always rule we can use in investing, Mark, is that there is no always or never in investing.
Mm-hmm.
I was going to
Especially
add,
accounting.
Ken, your view that a company isn't doomed to that back slope. I think probably one of the most well-known examples is Microsoft itself. We tout how well it's done. Remember, this is a company that owned the personal computer, completely missed out on handhelds, tried and failed, and then found its third life in cloud computing. It's a very different company now. I mean, it still has its franchise in PC computing, but many companies in a similar spot coming out might be on their way down.
Well, and if you're old enough to remember Apple, Apple is the same kind of example, Matt,
Yeah.
where it had to reinvent itself 3 or 4 different times. In fact, we could go back and demonstrate, maybe it's not in the bull sessions, maybe it's in roundtable sessions where we've talked about Apple reinventing itself and then watching the graphs do what they do. And that's, I guess, the point I was making, that a company does not have to move into decline. Although when you look at the list of the stocks that the Mutual Club of Detroit held in the 40s and 50s, and you say to yourself, I don't know the names of any of these companies in this portfolio, you do see that 50 or 60 years gives you a really nice, not nice necessarily, but a really good rotation of companies that exist as good, solid growth companies. So all in all, this is a great overall picture of the life cycle, and it doesn't really point to any specific company at any specific time.
But as we go into the rule breaker thing, this is Blockbuster, and Netflix is up here somewhere.
Yep,
So as you think about rule
absolutely.
breakers, you've got blockbusters like that, Blockbuster to Netflix. The other one, back when we did this presentation, at one time, Commodore had a 30 or 40% market share.
At least.
Yeah, I mean,
at least, and you were always trying to make the decision: do I buy a Commodore or one of these other brands? And there were a lot of other brands at that particular time with the personal computer.
What was the one with the cows? Gateway Computer.
Gateway with the black and white boxes.
All right, so here was Hugh's message in general, and we talked about this back in that 2020 session. Back in the the 2013, 14, 15 timeframe, they were building out Amazon, and they were spending money building the business. Yeah, but they did have some cash flow. That's what you're seeing down here. And we attempted to explain that, Bezos would stand in front of herds of the rhinos and say, guys, I can give you whatever earnings number you want. That's not what I'm here to do. I can literally close a factory, lay some people off. I can make those earnings numbers whatever you want. I'm not here for the earnings. That'll come with time. And that's kind of the message that Hugh had for us back in 2014. And you saw this business just building up. You can also put Barnes and Noble at the bottom of that previous chart, replaced by Amazon. And eventually the earnings did take off as the company really thrived. And here was the cash flow over time. Go ahead, Ken.
And meanwhile, in that place that you have circled red, PE values were non-existent or astronomical. The PE values were not telling us anything about this company at all during that time period. In fact, even if you wanted to extend that circle up to 2017, we probably weren't getting any real read from PE values. They just weren't helping.
Yep, much like today's Palantir, but that's foreshadowing. Here you go, just looking at a couple of the other characteristics for the company. Cash flow per share over time, looking pretty good. Here was the actual presentation made at the National Convention by Hugh McManus back at Chicago 2014. You probably remember it well, Ken.
I do.
And he disclosed that he'd done his shopping for companies. He likes to shop for companies near their 52-week lows. And that's part of the Hugh McManus approach. Here's his stable of vetted companies. And Amazon was fairly close to the top of the list. He does own a number of the companies that you see on the list here. He's brought a few of those to the roundtable. So that's where Amazon came from. It was a company that intrigued him, had this improving picture from right here. Even back in 2014, he's looking at this saying, I think they're onto something here. So he's looking at that. They're near his, they're approaching their 52-week low. So here was his summary that day. Again, a cash generating machine. They seem to be running their business quite well. They had taken over the lead in the space. He says that the price wasn't perfect, but I don't think we can argue with that perfection. Those are the actual selections made during 2014 that you see there. So $2,000 is now worth, what does that come up to, Ken? That's about $31,000.
About $31,500, yeah.
And so this is a pretty good result from a company that had a PE ratio of about probably 800 at the time. So that's kind of the message. So again, found it using ChatGPT. So back to Palantir. Oh, go ahead.
And
Ken.
Mark, we sat at that convention, listened to this presentation, listened to the audience reject the presentation, and listened to the panel that we were sitting on kind of laugh behind their hand about what Hugh was talking about. We just didn't think he was real serious at the time.
I will, however, say I raised my hand because I saw nobody voted for it.
Well, you were. That was a pity vote, Mark. Okay.
No. I agree with the premise. Always have. I take partial credit for this one, Ken. All right, so here's your learning, more of your learning for the day. What a Palantir actually is. Those of you that have read Lord of the Rings with your grandchildren or children, you already knew this. I didn't, but it actually comes from Tolkien's Lord of the Rings.
So your homework tonight, folks, is to figure out what Kenya is. Back it up, Mark. Your homework for next bull session, folks, is to tell us what QUENYA means. Okay.
All right, you got me. I have to deploy some artificial intelligence to figure that one out, Ken.
Well, some of us know. All right.
I know some of you know. I know that my son would know. I know that my wife would know. All right, so here's a look at the company. Palantir, as far as what they do, they are in the consulting and application software and infrastructure software business. I know that doesn't explain it yet, but at least it gets us in the ballpark. They do a lot with government contracting. They just closed a $10 billion contract with the Army. So it is a company that's firing on a lot of cylinders. What you see here is just a demonstration of, if you just look at the numbers, they didn't have earnings until recently. They're down here somewhere, right? So they did finally come in. The question marks are pointing out that some of the value line numbers that you see for their 3 to 5 year forecast seem unusually low or worthy of a question mark. The same is true of these stock prices, which have literally been blown by already. So again, going back to how do we look at this company using Prove? So you're basically looking at a company with an extremely high growth rate, somewhere between 30 to 40%. And again, that $10 billion hasn't landed yet, so it's going to land. And it'll be interesting to see what impact that has. So the major question that you have to answer as you look at this company, because if you look on Finance Yahoo, the PE is 650 or something like that right now. And you really want to look at the business model, and the number one thing that you're trying to understand as you attempt to gain an understanding of the company is their profitability for the future. And what I would point out is these numbers are not terribly far apart down here, probably suggesting that maybe this PE could be trimmed a little bit if you really want to insist on getting closer to that 2%. But there's more here than you would think when you see that 850 PE. This is not in the sell zone according to a traditional guide, and this is not the worst number out there when it comes to a projected return on value. So the real
Mark, I have a question for you, and I think maybe I have some instincts about it, but I'm not quite sure what the answer is. How realistic is a 50% margin for a company that deals in services?
That's an excellent question. It probably goes with this one. So you see a company that has a cash flow growth rate in the 30s. That's kind of a check on, what type of growth rate is reasonable, plus or minus. Okay, and that's the question here, Ken. I mean, where's this going? We don't really have enough to figure out where does this land out here. So this question mark is a huge question mark, and here's the answer to your question. How often does this happen? And if you throw up companies like Microsoft and others, and you look for, what type of company is this? What is possible with respect to future profitability? I find this one kind of compelling.
Just if we talk rule breakers, Interactive Brokers is 70% and climbing.
Right. So again, you really got to wrestle with this. Where do you end up? I mean, here's a gross profit margin, which is going to be fairly similar for a services company. They're currently chopping away at 80%. So that is the question that you have to come to some understanding, because you throw a 60% number in here, this number becomes, I don't know, 3, 4, or 5, something like that. It's not a terribly bad number.
Here's the reason for my question, Mark. A lot of times when we're looking at par and proof, we use it to temper the PE value. And you mentioned that when you showed the slide, that maybe we want to drop that 100 PE down to maybe 85 or something like that to move it closer to the 2%. But I'm wondering if Palantir might not be a case where we've a slightly overestimated PE going forward and slightly underestimated operating margin. In my experience, operating margins for heavy-duty service companies can move pretty easily into the 55–60% range. And that's what you just demonstrated on the next couple of slides. And so maybe this is a case of us wanting to temper both of the numbers and to bring them somewhere closer to the midpoint of the 2 and the 7, rather than to move them to the extreme of 7 or to the extreme of 2.
Yeah, and you're nibbling at that area. This is, at least in this respect, this year's NVIDIA, because Value Line was looking for a profitability, an operating margin profitability of about 20%. Back just a few months ago. They're now up to 35, and they're just ratcheting it up. I would expect their next report to even be higher. So they're just dramatically underestimating, where this can go, and that's just a personal opinion. I could be wrong, but that's my instinct, is that they tend to, when we talk about how Morningstar, Value Line, and others struggle with this type of company, like they all did with NVIDIA a year ago, this is where it falls apart. And Ken's question, it's perfect, Ken. You got to figure out exactly, how do you put this company together? What do you expect from the pieces? And, what is a reasonable, and that's the question that I asked. I mean, what type of profit margins make a lot of sense here?
I also think, Mark, that when we're looking at an explosive growth company like Palantir or NVDA or Netflix during some of its periods, or a lot of the companies that are on that list that you just, that's flashed up again right now to us, I think we have to remind ourselves that quarterly figures can give us seismic changes in some of the numbers. And it's not a gradual kind of movement in some of these companies that are growing so quickly. And when a number explodes, might go 1.5 or even twice what we expected it to be, that changes the model drastically, and it
Hmm.
can do it in as little as 3 months. So we have to stay right on top of the numbers if we're going to use any of them to our advantage.
Yeah, this stuff is dynamic, and I think if I'm allowed to issue homework, Marie Frank, I'd like to hear you answer that question. What is a reasonable operating profitability for this company? I mean, she's in neck deep into the company. It would be interesting to see if she can latch onto some resources which express that opinion. I bet you she can. So we'll come back and actually talk about that in the future. So for now, that hopefully that gives you some understanding of the type of thinking you have to do when it comes to the profitability of a company. By the way, it's fascinating to watch value line. These are basically value line numbers. I mean, these two are laying on top of each other. There's usually a gap between the two. It's a sign that maybe they've got a little more head scratching to do. All right, so we'll come back and look at this a little bit deeper, and that's a question for everybody out there. What is a reasonable thing to think about here for this company? So with that, just a quick reminder that we do YouTube archive all of these programs on YouTube. You can access them there, including the stuff we dug up using ChatGPT earlier. I am headed for Atlanta. Ken's going to go along also, and we're going to spend a few days with the Atlanta audience. They're always wonderful. And this is one of the themes we're going to be celebrating down there this coming weekend. Reminder, Roundtable is 1 week away. Do you have your stock selection yet, Ken?
No, but I have it narrowed down to 3, so that's pretty good.
I almost have mine if I go with the stocks that I used down in Atlanta. And here's our images for the week. And you, of course, recognize the one on the left there, Ken, right?
I think that's the Grand Hotel on Mackinac Island, isn't it?
It is. Complete with northern lights. That's a nice picture. And then we
The
talked
longest porch in the world, folks.
Yep. It's a beautiful place for sure. And then what's not beautiful is when Jerome Powell lands in Jackson Hole. Let's hope he makes that putt, Matt. And that we don't see that cloud formation.
Hopefully he's got a good read on things.
All right, so that's all we have for today. Anything else you guys want to add, or any other questions from the audience, or things we need to cover?
We're getting virtual applause from a couple of folks in the audience, and we're thanking everybody for that applause. It's appreciated.
Yeah, these are fun topics to delve into and understand better as an investor. And I mean, I'll go back to this slide, and why would you want to spend time scratching your head? This is why. You don't have to do that too many times to really put a smile on your face as an investor. And that's straight from the roundtable, which we will be visiting next Tuesday. Good stuff. I would say this is better investing, Ken.
Well, I just think we're all ready to say good afternoon to everybody, and we'll welcome you back again at 2 o'clock in the afternoon Eastern Time next Tuesday.
All right. Thanks, everybody. Be safe.
Bye-bye, all.